Great. Well, thank you everyone for spending some time with us today and for joining today's panel. I'm super excited to introduce the speakers that you have today. We've got a really great session set for you. We're going to run for about 45 minutes or 50 minutes, and we look forward to sharing a ton with you. Today's session is entitled Digital Securities, Evolution of Financial Markets. And we're super happy to have three really qualified and talented panelists today. On the panel, we have Simon Forster. Simon's the co-head of digital assets at ICAP, a role that he has had since December of 2018. Prior to that, he's spent almost a decade holding various positions at ICAP prior to the merger with Tullett Prebon. Simon began his career at the investment bank of SocGen and ABN AMRO. In his current capacity, he oversees the digital asset business at ICAP and is responsible for the strategic direction and the growth of that business. We also have Alan Konevsky, who is the Chief Legal Officer at TZero. Alan has been with TZero for almost 3 years now, and prior to joining the firm, he held various roles at MasterCard, including Senior Vice President of Strategic Initiatives and Technology Council, as well as Senior Managing Counsel as well. Prior to that, he spent some time as an MD at Goldman Sachs, and he spent about a decade at Sullivan Cromwell as well prior to that. Finally, on the panel, we have Mark Smith. And Mark is the co-founder and the CEO of Symbiont. In going through bios and preparing for this panel, I have to highlight that he's held that role since founding the company in 2013. And for those of you that have been around, that's a badge of honor. That's quite a long time in a space that's really evolving. So super excited to have Mark to share some insight that he's learned over the course of the past 7 or 8 years here. Prior to founding Symbiont, Mark spent his career in financial sales and as a serial entrepreneur, founding several different startups, many of which have had successful exits, several of which to Citigroup as well. So on that, please allow me to kick things off, and I'd like to start with a couple of questions. I'm going to start with you, Mark. And the place I'd like to start, I think, is trying to help the audience understand, what the difference is between a digital asset and all these other things that we hear about. At Arca, we look at digital assets in 4 different buckets. Cryptocurrency or money, which obviously is store of value or medium of exchange. The most common and well-known, obviously, is Bitcoin there. Decentralized protocols and platforms like Ethereum, Cardano, or EOS, asset-backed tokens, similarly to what you're seeing with SocGen, they're debt-backed tokens, even Spencer Dinwiddie's NBA salary-backed token, and then obviously securities. So I think that setting the stage for this conversation, Mark, if you could take us through how you see the universe and how you see digital securities, would be really helpful.
Absolutely. No, thanks. Thanks for asking me, Jerald. And it's wonderful to be on the panel. Great to meet Alan and Simon, and excited to participate today. I often hear, the term digital assets and digital securities as if it's new and it's come out of nowhere, and all of a sudden this all was born sort of with Bitcoin. And for those of us who are grizzled, not just in this industry, 8 years, I guess I'd be grizzled now in this particular industry, but going way back to the beginning of my career in the mid-90s, we really saw the electronification of Wall Street, and we saw the beginning of what we would consider digital securities, digital electronification. And that even goes back even farther as you go back into time and understand sort of how we got here. And we got here really through a lot of rules and regulations and a mismatch between the UCC and the states and the way companies incorporate, and then the way that Wall Street needed to clear and settle transactions. And most people have heard the story of the paper blizzard of the early, late 60s and early 70s that led to the creation of the DTC. And the creation of the DTC was really a compromise. There was a desire to actually move from paper certificates promulgated into electronic certificates natively. But the problem was, back then, it was extremely expensive to store anything. If you wanted to go buy an EMC large set to store, most states couldn't afford to do something like that. It was also almost unfathomable to think, how am I going to track those? So most states said, we want to keep paper. And what most people don't realize is it's in fact the states who have the authority to make those decisions for companies when they incorporate and how they structure this ownership and create share registries and so on. So Wall Street had to go to work and figure out, how do we resolve our problem with this paper blizzard? We just can't move the certificates fast enough, but also stay compliant with uniform commercial codes with the states. And the answer was, well, let's just take one big paper certificate, put it in a trust company, and then create electronic rights off of that all the way down. And that's the system we still have today. So we've had sort of electronic records and representation of security ownership for quite some time. I think what we're thinking about today is digitally native, things that are originated natively in this format, never in the regime of paper, not in the current regime of the DTC or other types of central depositories. And how then has that evolution occurred, and what are the opportunities in which we can embrace today? And that's really where we're taking off from, and that's where this innovation is happening. And if you think about what we were able to do in the electronification of Wall Street, which all started with matching, the structure that we had with electronic certificates worked just fine with matching because everybody was in the process. So we could just add a matching engine and shift from open outcry and OTC market making to electronic matching of buyers and sellers, but still clear and settle the trades the same way. T+3 in the old process, everything's great. And we saw an explosion of growth in the markets. And for someone who was there at the beginning, my first startup was one of the first ECNs approved by the SEC. I got a front row seat to see what real disruption looks like from outsiders. We were outsiders building matching engines that were quasi-legal. And then the SEC found a way to use those matching engines to solve problems with collusion. And then from there, matching provided for the opportunity with straight-through processing, algorithmic trading, high-frequency trading. Spreads collapsed. We moved from principal business to agency, and volumes exploded. And now we have the markets we see today. So we're now in that transition from, I think Alan said previously, not the back office and middle office, but the removal of office altogether. No more front, back, and middle, but everything happening. And it can only happen this way if you transition to digitally native securities run on distributed ledger blockchain solutions that fall within the compliance regimes across the globe for traditional securities. And that's what we're aspiring to do at Symbiont. And I think that's where, we're really excited about what can come next.
Cool. That's great, Mark. So let's take that a step further then, and let's look forward. So if we start thinking about digital securities and the evolution of the way that kind of capital markets are operating right now, what's like something that people could latch onto, right? And if we're talking about the future, right, we're thinking about the next 12 months, next 24 months or so, right? We're talking about systems. Mark was talking about systems that have taken decades to build. What should someone look forward to who's not really familiar with digital securities, and how can a digital security really impact what one would see as like a traditional business flow?
You want me to take that?
Oh, Alan, I think that was at you. We're good with
that was me. Excellent. Thank you, JD. And again, really delighted to be here. Sorry I missed my cue. I think the question is, and I think Mark summed it up perfectly, as we go this migration from paper to electronic book entry to native digital ecosystem with digital infrastructure and blockchain technology powering the rails, the single layer of technology that's going to be powering the rails for movement of anything of value. And JD, you talked about this earlier. In this case, we're talking about one slice of its securities, but it could be anything of value. And that one single technology layer, when I say single, I don't mean to get into the debate of which protocol wins and other technology standard conversations. But we're talking about a set of technology rails that is powering the entire life cycle of security creation, from issuance to record keeping to trading or transfers to settlement and custody to compliance features. And that single technology layer, along with tools that connect with it through API or interfaces, would displace layers of market participants, intermediaries, and systems that currently interact in the way that Mark described, that accreted over the years to build trust in the ecosystem or solve other problems that Mark summarized that can now be solved in a far better way. Now, that is not a kind of an instant on and off journey. You're going to see that unfold. I think you talked about 12 months, 24 months, or beyond. That you're going to see that unfold iteratively as the technology is permitted to play a greater role in that life cycle, whether initially just from a transparency perspective, so shining a spotlight on the company's capital structure capital structures are notoriously opaque. That's principally a reason of the ownership system that Mark described, where most public securities are held in street name by broker dealers through the DTCC. And in order to have an accurate view of the capital structure and take into the account of how it's influenced by investors who are taking short positions and the lending of securities and how that impacts is very difficult. That's why you have situations where you have a corporate action and more securities show up than they're outstanding, and you have to reconcile that. So the transparency piece of blockchain, which is live and actionable now, is a critical first step. And we've made some important market innovative actions on that. Then the next step you're going to see unfold is custody of securities on chain by broker dealers, custody and settlement. And there are some important rulemaking that came out of the SEC towards the end of last year, both a no action letter as well as a statement that will drive that. And so I think you're going to see that unfold. But at the end of the day, driving towards the vision of a single technology layer together with kind of connective tissue around it that plays the roles that before were divided up among a range of participants.
Excellent. There's a ton in there, Alan. We're going to return to a bunch of those different topics. I want to return back to custody on chain. I want to turn back to kind of some of the evolutions that we're seeing here. Before we get back to that, let's move over to Simon for a second. And for those that don't know Simon, he runs his business from the UK. And I'd be curious to kick off with that from kind of the UK perspective a little bit. Are there trends that you're seeing right now with reference to digital securities? The constituents, obviously, of ICAP are the banks and large-scale financial institutions. What can you share with us about what you're seeing right now from that space?
Yeah, well, pleasure to be here, JD, and nice to be on the panel with Mark and Alan. Yeah, I mean, it's very topical. I think what we are seeing are pockets of innovation across the value chain, whether that's on the custody side, whether that is on the primary issuance side, whether that's on the trading side. But what we still haven't seen yet is kind of a value chain that is serviced at all points across jurisdictions that have equal regulation or the same application of regulation. And I think that's where it's quite disjointed. Being the world's largest IDB, we have a pretty unique footprint in terms of the diversity of our client base. And we've been approached by a number of banks asking which assets should we represent in blockchain format? Where do you think we will get traction? And that is kind of the question that I still don't think has been answered. There's a lot of innovation. People can create these securities in isolation. And there's some destination platforms where you can actually go through the full life cycle of an asset. And this is a paradigm shift in terms of the life cycle of an asset. But connecting different participants and doing so to create a marketplace is the challenge that we're all faced with. I think fundamentally we do get there. The question is how and at what pace. And something that certainly from a ICAP perspective we're seeing from our clients is they are focused today more on the unregulated space. It's crypto. It is getting knowledge. It's gaining understanding of this new technology layer because that's where the liquidity exists. And if people are right that this is going to be the future of finance, this is the new infrastructure on which financial markets will operate and be built, then building that understanding, that expertise and that knowledge in crypto today will stand people in good stead for tomorrow. And that's certainly a trend we're seeing across the banks in this space.
That's interesting, Simon. So, kind of one would have thought that, at least kind of a layman would have thought that the banks and the financial institutions, would be tempted by, kind of the potential riches involved in some of these unregulated assets that you mentioned before, but might be seeking regulated solutions because of some of the protections or some of the additional, regulation, if you will, that they might be familiar with. Does that come up in conversation very much, or do you think that's really forward-looking?
I think it is forward-looking. I think there's clarity required from the regulators for banks to be able to engage in spot crypto. What we're seeing is banks engaging in other products that give them the access and exposure to this new asset class, be that through listed derivatives, OTC derivatives, exchange traded instruments, but with a view that the next step will be to think about how they engage in the spot market. And that's a lot of the conversations we're having. But as soon as a client, a customer or a bank starts to think about crypto and they start to look at this new infrastructure, it's a much easier step to then go, I now have an understanding of what this could mean to another asset class. The efficiencies that Alan touched upon, simple procedures and processes, dividend payments, shareholder voting, they shouldn't be as complicated and complex and burdensome as they are today. They absolutely will be improved if, as and when, we shift as an industry onto this new infrastructure. But I still think there's a step for a lot of banks to take to go from where we are today and these pockets of innovation at different points of the value chain to where we get to tomorrow, which is an ecosystem that is functioning and built on this technology layer.
Awesome. So building on that, I think that a lot of the folks that are probably listening to this session right now may not be aware of a lot of the activity that are happening at banks. And I have to say, there's a tremendous amount of work that's going on, kind of behind the scenes, many of which are not public. We're tracking these things, and you've obviously seen, a lot of activity out of SocGen with their, their covered bonds, and obviously, Mitsubishi's been doing a lot of work over in Japan, and BNP Paribas and Curve with their original and early POC for security token transfers. We're lucky enough that Mark's company is native to that, and they're playing a role in that development with the software that they're providing and their private blockchain that others are developing on. So Mark, kind of maybe you could help us, and I'm not asking you to really kind of give up any of the trade secrets here, but maybe you could share with us a little bit about some of the activity that could captivate the imagination of the folks that are listening that aren't really quite even sure what's going on in the digital securities market.
Yeah, it's really interesting. And I can say that the current move in the crypto market over the past 12 months has really helped innovation in the traditional side, because as Bitcoin started to run and those markets started to run, there was a real fear that, okay, these economies coming out of the ground. Not only are they interesting and there's value and there's new technology, but that's a real threat to the way in which we operate in the traditional world. And how are those two things going to either combine, or are they going to scaffold up next to each other? And potentially you don't want to be caught in a competition where you lose after 150 years of being a bank, and you wake up one day and find out some DeFi protocol has taken your place. So what has happened is that the messaging that's been going on for quite some time, if you think about the evolution here, it was a lot of education in 2013, 14, 15, and then sort of a big run-up, hyped, and then we went into the trough of disillusionment, which was my favorite place to be, because that's where all the work gets done. And in there, we were able to build and to build really deep relationships and build strong theses around how this technology as a problem-solving set, not as a new economy builder. And that's where we sort of draw the differentiation between what's happening in the crypto world and what's happening, to solve real problems in the traditional financial markets. And so you can start to see areas of opportunity where this technology can really shine. And what we're finding is that, first and foremost, this really brings a massive amount of value to the asset managers. It brings a lot of value to the buy side. Historically, the asset managers and the buy side just sort of had stuck waiting for the sell side. I use old terms. I apologize. I'm old. So sell side and buy side is still the way I think. Delivers products to the buy side, and the buy side accepts those products and uses them. Now, for the first time, the buy side can go out and innovate in ways in which they can take more control. As we talked about, potentially moving towards a more property right regime, where we have digital native securities that don't have to go into a CSD, that can be issued directly to the asset manager and then co-custodied using technology we learned about from the crypto world in multi-sigs, and ways in which we can still abide by all the rules and regulations, allow for those entities that want to be empowered and enabled to grow the business. Custodians that want to evolve and change can be empowered and enabled to use this new technology in ways you never could before. So what we're seeing is that anything that has a very arbitrarily complex workflow, something like a two-tranche ABS or a syndicated loan, these things are natively peer-to-peer. They trade in over-the-counter marketplaces, so there's no centralization already. They also provide for an opportunity to really leverage smart contract technology, be able to leverage the automation of that instrument, to remove all that inefficiencies during the course of the life cycle of that instrument. And you can then issue something natively onto a blockchain as the sole custodian. And when I say custodian, I mean custodial technology, but still allow for a transfer agent to run a smart contract to perform their regulatory duties without having to actually perform them in the old way, allowing a custodian to custody in a way in which you can use multi-sig, and allowing an investor to actually have property rights, and then introduce more efficient systems for trading. So in that same example with an ABS, in which we participated with Ford and State Street and Bank of New York and Citi and Vanguard last year, where we issued a two-tranche 3-year bullet that was completely automated. And the issuer, Ford, actually structured it themselves. They took control and ownership of the structuring. We utilized laws that we helped create in the state of Delaware to create a special purpose trust that was only a smart contract. There was actually no real documentation as you would think of to form that trust as that piece. And then we had Citi act as agent and simply sign the transaction to allow a direct issuance down to the investors. And then once issued, those investors are now in a peer-to-peer network that's pseudonymous. So without disclosing who they are, they can communicate to all the other holders of an ABS, allowing you to be compliant to Reg AB2, and then open up and transact with one another freely without any middlemen necessary, and allow the custodian to sign post-transaction execution for that transfer and for the consideration. So that's just one example of areas in which this technology really is powerful and is going to change the way in which we view these kind of structures and allow for not only improvements of these kind of vehicles and the bringing back of things like RMBS and CMBS. These are very important instruments that have been, lacking in our marketplace post the financial crisis. And by being able to combine all these things on a singular platform, as Alan said, where you can have the servicing of assets, the issuance of those assets, the trusts created, the securities created, and then issued all off the same platform, now we have a very safe vehicle in which we can see payment by payment what's going on inside those securities and never be caught out of the loop and inside a walled garden like we were in the last financial crisis. So that's where we're looking to expand. And I think that's where, if you view this technology as fintech and a problem-solving set, those are the areas in which you can really dig in and have great value. I think the areas in which we get in trouble is when you chase the shiny object and try to get into that more high-frequency trading environments in which this technology isn't built to do. Right? We're never going to be as fast as a centralized system, nor do we want to be. We want to be correct, we want to be efficient, and we want to create new opportunities for structure. And that's where our partners like Citi and Vanguard and others are going, and that's where we're going with it.
That's super helpful. Thanks for that. And I think that really, kind of helps, kind of captivate the imagination about, kind of financial markets. And if you adopt blockchain technology, if you utilize, kind of a token, the efficiencies that are created are quite great. That's what we're talking about when you're dealing with, peer-to-peer transfers with a couple of, large, extremely large players. But what happens when you take something that's kind of out in the open, right? And you start taking digital assets that can move, as we were talking about, peer-to-peer, right? From one, entity to another, from one individual to another, and then ultimately they end up on something like an ATS, for example, right? So, Alan, kind of when we start talking about, the evolution here, one of the places where most people are looking at are infrastructure, trying to understand, kind of what that infrastructure looks like, how will it help take us to the next evolution and level of growth. Can you share with us a little bit about, TZero, how TZero is going to be playing a part in that story, and how you think that, TZero's capabilities will help captivate, kind of the securities markets as a whole?
Sure, happy to do that. And I'll try not to make it sound like too much of a commercial, but actually.
Yes, thank you for that. And I'll
be useful, but I think we can do both. So what you're saying is absolutely right. And I don't want to get too much into the detour of, well, crypto trades in the particular way, and it should or shouldn't trade in that way, and environments where crypto trades should or shouldn't be regulated in a particular way. Although I'll make an observation that the new chairman of the SEC, has made direct comments on that topic, and whether non-security digital asset trading environments should be more regulated, particularly if they fall outside of the SEC and CFTC jurisdiction, and what's required to achieve that, which is probably an act of Congress. But if you go back to the paradigm that you described, then you're right to kind of use your words carefully. Securities, and I don't think anything of what we're describing, what Mark and Simon or I described, changes the fundamental analysis of some things are securities, some things are not. We're talking about things that are securities for purposes of federal securities laws. There's a lot of law on that topic, some of it not very precise, and that's another conversation that's going on in the market, is more regulatory clarity on the definition of what's a security and what's not a security. Again, that's a separate panel. But if for something that is a security, and if you wanted to trade in a continuous automated environment, your ability to structure that in an unregulated, purely technology-driven, peer-to-peer ecosystem at this point is constrained from a regulatory perspective. And that is that if you're running a particular trading environment for securities, and it either has to be a securities exchange, and you have to go through registration and approval to become one, or you have to operate under an exemption from the requirement to be a securities exchange, of which an alternative trading system, an ATS, that you described is a good example. And that's where we come in, and we happen to have our feet in both spaces, both in the ATS land, and we own a broker-dealer that operates an ATS that currently trades 3 digital securities with a very meaningful pipeline for more. And we're also a partner in the joint venture to set up a national securities exchange that's going to utilize blockchain technology in an incremental step-by-step measure that.
So Al, I'm going to cut you off for a second here, right? And I'm just going to try to get to the meat of this one, right? So the question really is, what's it going to take for us to get the securities market from, let's say, $650 million, right, in value, to something that people will look at and start saying, oh yeah, this is a place I want to play. This is a place I want to invest. This is where I want to manage risk. What do you think that's going to take?
Well, you know what? So that's an interesting question. Look, I believe at some point in time, we're not going to be talking about digital securities anymore. We can be talking about securities. Much how when you had the shift from paper to electronic, at some point you stop talking about book entry securities. You talk about securities. At some point, you'll just talk about securities because everything will be digital. And that shift to the technology layer that's going to perform functions that are currently balkanized and spread out among a bunch of participants, that's the end state. Now, as you're getting to that, towards that end state, the conversation is, well, as an instrument that utilizes this new technology, why is this of interest to me? And I believe, and look, like anything, it's a function of supply and demand, and there's a bit of a catch-22 element to it, but I believe the supply wins in this conversation, and you will need to see, and I think you're seeing this already step by step, more issuers recognizing the benefits of the technology, what Mark described, whether you're designing structured instruments or whether you're offering more plain vanilla securities, and you want to have more insight into your capital structure. You want faster settlement. You want automated compliance. As you get more assets, as you get more issuers, and whether they start out as private securities that may be traded freely under federal securities laws that utilize this technology, because that's easier to reform than public securities. I don't think you're not going to see NASDAQ reformed overnight. And so you're going to see this journey where more and more private securities, and by the way, the need for liquidity in private securities exists independent of this technology digital conversation. But as you see more private securities that can trade, starting to trade on ATSs that utilize digital technology, that's going to attract more investor attention, including institutional attention, including regulatory attention from the benefits of this technology, and then the virtuous cycle continues.
Got it. That's super helpful, and Al, that's awesome insight. And I think that when you couple that with what Mark was saying earlier, right, and you start talking about, you know, the shift to electronification of markets, and, you know, the distribution of products and services and the creation of efficiencies, I mean, that's really a serious conversation. Simon, I know that's a place that we've spent some time talking in the past as well. How do you see that?
Look, I think one of the interesting, maybe this will end up for a question for the group and maybe to Mark, one of the things that I think we collectively agree on is this technology provides a paradigm shift for the life cycle of assets in the regulated space. And I think we all agree that that is where we get to. I think how we get there, no one quite knows. But one of the outstanding questions, I think, is, you know, if you look at open source blockchains, which, you know, in our view are public utilities, you know, they have network effects that historically, when you look at technology adoption, are unparalleled. And you see some of the things that are happening in DeFi, to your point, Alan, and how robust that was over the last few weeks during a very turbulent time in the crypto markets. A question to the group, and something that we are still, I guess, as an industry, yet to see this play out. You know, enterprise blockchains and destination platforms, you know, you do get traction. It is easier to see the life cycle of a security or a trade from issuance to trading and settlement, and, you know, through the entire that spectrum. But I'm not sure that scales to the point that you see the new financial marketplace develop. And I don't know if I'm thinking about this wrong. And Mark, I'm sure you've got a very strong view on this and very interested to hear it. But I think there's two things. One is the regulation, which is slowly catching up and still needs to, because there are some nuances around this new technology, even if it looks and acts like a security. And the second point is, how do we marry up the regulation with the unparalleled power of open networks versus enterprise solutions?
Yeah, and I think that's awesome, Simon. And the one thing I would ask then, you know, here, and you heard this in the last panel, when we're talking about things that kind of, you know, scare, you know, folks and cause them to stay up late at night, you know, the fact that we're talking about, you know, foreign entities, regulatory bodies, potentially even colluding against, you know, the SEC for a competitive advantage, that's like real serious stuff there. You know, blending two panels together, I mean, in like, you know, 30 seconds or less, guys, is that a real fear for us with reference to the security space? Or is that, you know, something just
What's new? Yeah. You know, regulatory arbitrage has been going on forever. And anytime there's an opportunity to take advantage of it, either from the business side or from one regulator to another, it occurs. So this is just another, you know, long-standing issue with regulatory arbitrage. I think one of the things that we've seen and that we, you know, believe is a broader-based thesis is that one of the advantages that the scaffolding up of these economies in the crypto world is that you can be open source, break things, and people kind of don't care, right? So, I mean, remember the DAO fork. That if that would have happened in an enterprise setting, everybody's out of business. Somebody's going to jail. No one wants to talk to that company again. There's no trust. Ethereum just went on with 2 coins, and now look where we are today, right? I think we're seeing the same thing happening in DeFi. These applications are not the best coded. They're going very fast, and they don't have to ask permission, and they'll just try to ask for forgiveness in the future. And what's the huge benefit is the alignment of incentives. There's a singular incentive going on, and that is to grow the value of these tokens, these coins, whatever we want to call them. And so speculation being the number one use case in that area, and continues today as the number one use case. If you then turn the tables and think about what Simon was just saying, and how do we build these network effects and build these marketplaces using this technology in the more traditional world, in which we can't break things and expect to survive, where we can't go afoul of a regulation and expect to survive. We can't ask for forgiveness later. You know, I look good in orange because Symbiont's orange, but I look terrible in an orange jumpsuit, so I never want to go there. And so what you have to do is think about the alignment of incentives, and that's really where we are today in the enterprise space, I believe. And the conversations are around how do we align those incentives? Because to run a node in a network that doesn't have a token, there has to be some other value there for you as the participant. It can't just be for fun. And so you have to be able to quantify that value. And what we're seeing is issuers, we're seeing asset managers, we're seeing players who have been put in boxes throughout history, who are now seeing the decentralized world and realizing they have power. And that power can lead to the creation of new and innovative technologies around what they do and put them in a whole different conversation. So when an issuer comes to someone like T0, never in history have they been able to dictate what the extra value is that they have, what they're going to be able to do on the platforms. When we look at what we're doing, the same thing. You're able to sell not just, hey, here's a new SaaS system that's going to create a small amount of efficiency for you. We're going to put you in the middle of everything, and you're going to be able to drive the innovation along with everyone else. And that kind of incentive and the ability then to talk about the art of the possible. Once we solve the existing problems that exist, like proxy voting or cap table management in the private equity sector, or structuring of highly sophisticated instruments like syndicated loans, then the question is, what are the new products we can build with this technology with you in mind? And that idea, I think, is starting to take hold. And it's taking hold, again, because we have the benefit of watching this rising tide in the crypto side and saying, see those things? We can do those things and other more exciting things in markets that are 100x the size and mature. And the players, the traditional players who would resist this, I think we're in this capitulation phase, very similar to what happened with matching. When matching first came out, there was resistance to matching. Market makers tried to dig in, open outcry specialists tried to dig in. Then the next thought was, if we can't stop it, let's build a consortium. Those consortiums really didn't work well. Then it was, okay, let's acquire them and implement them, and let's change our business model. So you saw the survivors coming out of the early electronification of Wall Street were the ones who were able to pivot and say, okay, I don't need to take risk positions as a principal. I can create technologies to route orders and collect fees and become an agent and use my regulatory advantage of allowing access into the marketplace for those who currently don't, and then facilitate the development of technologies that can drive value for what became, high frequency trading. So I think we're at that moment in time right now in this industry where you're seeing these first instruments come out of the ground, and you're seeing different voices around those. And we think that's going to be where the exciting future is. When you look at a distributed system, when you look at a blockchain and you see, oh my goodness, there's an asset manager, there's a transfer agent, there's a custodian, there's a investment bank, right? There's a trading shop, all sitting on the same network, all working for their own rational self-interest while being incentivized by the value of the products they create together. That's pretty exciting.
Yeah, if I can jump in just for a second, I think that's absolutely right, Mark. And I think when you look at new distributed projects coming online, and if you ask yourself the question, well, how is it going to answer a problem that exists in the financial system? What use case is it going to have beyond speculation in a particular coin? If you can't answer that question on how it's going to serve as connective tissue, as technology layer for value movement and other activities that can be built on top of that, then that's probably not a good fact. Right. JD, you asked the other question about regulation and impact on the U.S. Well, one consequence of either not allowing things to happen or not clarifying things is that you push things offshore. And guess what? And blockchain is not the only example of that. When things happen offshore, it impacts you. And so the best way to minimize that is to provide clarity and a pathway for domestic innovation. It may seem counterintuitive for people who like to stop things from happening, but the reality is that if you want to stop these the flow back of potentially negative consequences from abroad, however under or overstated those concerns are, sort of irrelevant to this conversation, you give people a path for doing this at home. And that's the answer.
Awesome, Alan. I appreciate that, and I'd love to engage in this topic. You and I have sparred before on this one, and I love it. But unfortunately, we're getting close in the panel. I do have, absent any questions from the audience, I do have a rapid fire round of 5 questions that I've not shared with our panel just yet. So it's time to get nervous, guys.
I'm nervous, JD. I'm scared.
There we go. So I'll start with you, Simon. Let's see, where should I go? I'll spin the wheel. I'll give you the easy one. Who's going to evolve in a more meaningful way first, DTCC or Euroclear Clearstream?
Ooh. I think that's. I'm not sure either of them do, but if I had to guess, I'd say DTCC.
All right, Mark. Well,
Euroclear.
You've got a
definitely Euroclear, without a doubt. But private company, much more likely.
Alan?
I agree with Mark. Although there's a lot of interesting innovation going on that DTCC is thinking about.
All right. Banks holding digital securities in 2021, yes or no? Mark?
Yes, absolutely.
Alan?
Yes, absolutely.
Ooh, Sai?
No.
No. Okay.
Talk to me in October, Simon.
SEC approves a 40 Act structured ETF with Bitcoin this year, yes or no?
No.
No, Alan?
No.
Sai?
Nope.
Okay. Got a number here. Market cap digital securities as of this morning was 678 million and change. Where are we going to be in a year from now?
500 billion.
Nice answer. Alan?
At least 10x.
Love it. Simon?
Triple the size.
Love it. All right, last one. Biggest thing that you've got your eye on, top trend for digital securities over the next 12 months, starting with Alan.
I'd love to see some progress on the cash settlement piece of securities transaction. Nice. We talk a lot about the securities piece of the transaction, and there's been a lot of interesting stuff that came out of the SEC towards the end of last year that I mentioned. But until we solve the cash leg of a settlement cycle, the promise of instant settlement certainly remains a bit of an illusion, so long as you still need to move cash from the banking wire. So whether it's permitting broker-dealers to use stablecoins, whether it's central bank digital currencies, whether it's some other more ecosystems that for the time being have to rely on centralized environments, cash leg of the settlement cycle needs to be solved.
Awesome.
I will chime in very quickly to say I miss things that are obvious. And so in starting in 2014, we were telling every potential partner, listen, you're going to create a proxy token for $1. We're going to create an API off of our platform. It's going to go point to an omnibus account. We're going to use a smart contract to manage it to ensure there's no overspends. And that's how we're going to settle transactions. I said it over and over for at least 4 years. I didn't think it was a business. I had no idea that stable coins would become a business. I thought it would be so obvious to every single financial institution, because PayPal has been operating the way it's been operating for as long as it's been operating, because this is simple integration work, that we would already have many, many, many different on-ledger settlement consideration vehicles, and now we're in this stablecoin world. So I agree with you, Alan. The 800-pound gorilla has been and continues to be on-ledger, evaluate, some type of consideration for a security on-ledger for atomic transactions.
Simon, last one, my friend.
I've gone against the grain on a couple of these questions, but on this one, I'm going with absolutely. Fiat currency remains one of the biggest problems when you start to migrate into this new technology, and that is definitely a point of friction that the industry needs to solve.
Awesome. Well, on that note, I really want to thank this panel. This has been an awesome discussion. I hope that the audience concurs with that. We've been given insight by 3 just incredible individuals who are making an impact on this market, as we all are trying. So again, Simon, Mark, and Alan, thank you so much for your time. Thank you for your words, and thank you for your participation today. We'll see you next time.
Thanks, JD. Thanks, Alan. Thanks, Simon. Thanks, Arca. Appreciate it. Good luck the rest of the way.